For decades, the beauty sector operated on a strictly top-down model. Salons were centralized businesses, and technicians were employees, managed directly by the owner. But that model has fractured. Recently, the industry transitioned into a flexible, entrepreneurial ecosystem built around salon suites and booth rentals. This chart shows the current makeup of United States beauty salons. Today, independent rentals and shared spaces account for upwards of 37% of the entire market. Practitioners are driving this shift. Modern nail technicians want direct control over when they work, where they work, and the specific services they offer. Client loyalty has also moved. Customers no longer book with a salon brand. They follow their preferred technician to whichever physical location they rent. This gives technicians a clear financial incentive. By leaving commission-based employee structures, they can operate independently and retain 100% of their service revenue. But this pursuit of autonomy has created a massive legal blind spot. Thousands of salon owners and independent technicians are operating under agreements that leave them entirely exposed to worker misclassification penalties. The most common error in salon management is assuming that how you pay a worker dictates their legal classification. Owners and technicians frequently assume that issuing an IRS Form 1099 NEC or paying a worker strictly in physical cash guarantees independent contractor status. Federal and state regulatory agencies view the financial mechanism as completely neutral. Cash is just a medium of exchange. A W-2 employee must report their cash tips, and a 1099 independent contractor must report their cash revenue. The currency itself proves nothing. The same applies to checks and direct deposits. The automated clearinghouse network processes standard corporate payrolls right alongside automated rent collections and vendor distributions. There is, however, one payment structure that immediately attracts regulatory scrutiny. Allocating gross service revenue on a percentage basis, like a 60-40 split, without a fixed rent floor strongly indicates you are paying an employee wage. A 1099 tax form cannot protect a business relationship that lacks actual operational autonomy. Without it, you simply have a misclassified employee. When an auditor evaluates a business, they apply a single analytical standard: control. They measure 3 operational areas: behavioral, financial, and client management. If an owner dictates schedules or requires mandatory shifts, the worker is an employee. To maintain independent status, technicians must set their own hours and come and go without management oversight. The same strict division applies to pricing and services. A worker is an employee if the host salon establishes a fixed price list, limits the menu of services, or mandates specific product lines. Financial independence requires business risk. An independent technician must make a significant capital investment by purchasing their own specialized tools, sanitation units, and product inventories. Client ownership is equally scrutinized. If the host facility controls the booking database or enforces non-compete rules to stop a technician from taking clients, the independence is voided. This evaluation becomes even more complex at the local level. State labor laws frequently impose stricter standards than federal common law guidelines. Under the strict ABC test used in states like New Jersey, a booth renter is classified as an employee by default, simply because performing nail services is central to the salon's core business. Retaining even a fraction of control, like dictating which brand of nail polish to use, can unravel the entire independent relationship during an audit. To survive scrutiny, divide the operation into 2 separate entities. The host salon acts strictly as a commercial landlord, providing a safe facility, utilities, and property insurance. The technician acts as a micro-enterprise, supplying professional tools, managing bookings, and billing directly. This separation is formalized by the practitioner maintaining an active professional state license, establishing professional accountability outside of the salon's management structure. But separating the physical workspace isn't enough. Regulators routinely discard written contracts if they contradict what actually happens on the floor. Proper compliance requires a layered documentation pyramid, where paperwork builds upon reality. The foundation is professional and business documentation, like business licenses and EINs. The middle tier is operational documentation, independent ledgers and appointment books. The peak is relationship agreements, like the station lease. If an auditor pulls a lease agreement from the top of that pyramid, but finds the salon owner still sets the technician's schedule at the base, the contract is completely voided. The threat of an audit is severe, particularly for cash-intensive businesses like salons. The IRS Audit Technique Guide gives examiners specific instructions. If a salon lacks clear financial ledgers, auditors will reconstruct the business's income using appointment books, price lists, and regional industry averages. Failing this evaluation results in retroactive reclassification. The host salon is hit with levies for unpaid W-2 payroll taxes, compounded by interest and severe financial penalties. The best defense is a formal, quarterly self-audit. This prevents the gradual, informal shifts in control that blur the lines between landlord and employer. Salons and renters need a collaborative compliance cycle built on interlocking principles. First, transparency, openly defining expectations and audit standards. Second, operational consistency. Daily interactions must perfectly align with the written lease agreement. To thrive in a decentralized ecosystem, host owners have to completely relinquish control over the practitioners in their building. In exchange, technicians must fully shoulder the financial and operational burden of running an independent business.